Welcome to the Federal Retirement Podcast. My name is David Rates from Benchmark Financial Group, and every month we discuss important topics regarding the retirement planning process for federal employees. This Lunch and Learn series is an interactive discussion where individuals can ask questions. To join these discussions live, you may register by joining our email list at bfgkc.com. We also provide in-person retirement planning and benefit education to federal employees. To learn more about these seminars or to schedule a seminar at your federal agency, go to our website at bfgkc.com and click on seminars. Additionally, if you're looking for assistance to get your retirement on the right track, set up an appointment with us today. You can schedule an appointment online by visiting our website at bfgkc.com or email me at david.rates@bfgkc.com. The contact information is also listed in the description. By setting up a complimentary consultation, we can review your financial situation and develop a plan to meet your financial goals. We hope you enjoyed this topic and hope to connect with you soon.
Well, thanks for tuning into this month's call, everyone. It seems like lately we've been having a lot of conversations with folks that might be gearing up for planning for retirement at the end of September if they took the fork in the road offer, or gearing up for retirement at the end of the year. So we thought it'd be worthwhile to just touch on some of the essential questions every federal employee should ask when they're going through the retirement planning process. So feel free to chime in with any questions that come to mind, and we'll go from there. All right, so the first three: have you chosen the best time of year for your retirement date? So oftentimes that's a question of, a lot of times people target the end of the year, but if you're in a mandatory retirement situation, it might be mid-year. So there's just a few different variables that you want to keep in the back of your mind when you're trying to target the right time of year to retire. Usually there's a question that crops up about what happens to your sick time and annual leave, how you get credited for sick time and annual leave. Have you requested an official retirement estimate from your HR? That's always an important piece of the pie if you can get your hands on it. But if for whatever reason HR is taking forever today to get any estimates back to you, there's other sources of information that you can use that have some key pieces of info to keep an eye on. So we'll touch on that here in a second too. On with the list. So first, surviving spouse benefit. Which option do you want to go with? Do you want the maximum survivor benefit, the partial survivor benefit, or no survivor benefit? Are you up to date with your FEGLI coverage? Do you have the right amount going into retirement? Oftentimes with FEGLI, you got to remember, FEGLI is really cheap when you're early on in the process. So you get a ton of coverage when you're early on, and it costs next to nothing. It's just every milestone. You get to the point where you hit certain milestones of age and years of service where the price tends to go up noticeably. So that's oftentimes a conversation of, you've got this amount of FEGLI that you've been carrying in force. Is that amount enough, or you usually want to pinpoint your life insurance to a specific thing that you're insuring for a specific duration of time? What's your withdrawal strategy with TSP savings? You've been spending all these years saving. Now it's a transition to getting your mind to think about how you're going to generate income out of that pool of retirement savings. There's oftentimes several questions that crop up with when to claim Social Security, but we tend to gravitate towards turning it on sooner as opposed to later, but we'll elaborate on that here in a second too. Moving on with the list. How do you determine, or do you understand how taxes will impact your retirement income? Taxes are a little bit different on retirees, and depending on the state that you live in, each state's a little different for taxes on federal retirees. So some important info there. And are you clear on your federal health insurance options in retirement, or just knowing some handy tools to be able to shop the plans going forward? Do you know, and last one on the list is, what do you know about the first supplement? What is it going to pay? How long is it going to pay? What are some key important details that you want to be aware of? The supplement's always a nice piece of the pie, but the earnings test is usually one that people have a lot of questions about. And in a nutshell, with the supplement, you can't get the supplement and then go make an unlimited amount of money in terms of like W-2 salary type of income. So, all righty, digging into the list for question number one. Oftentimes, like we said a second ago, 12/31 is usually the most popular retirement date for a lot of FERS retirees. Why is that the case? Oftentimes people are trying to maximize their annual leave payment. They usually use the lump sum. Leave gets paid in a lump sum a couple weeks after the point of formally retiring, and oftentimes people use that chunk of leave time as kind of like their money to live on in the interim window while OPM's crunching the numbers, getting your full pension payment out to you. Because you got to remember, when you get to the point of being a retiree with OPM, that process where they're auditing your employment record and coming up with your final pension amount, that one usually takes about 2 to 3 months on the fast end of the spectrum. So like we said, oftentimes leave becomes that chunk of money to live on for monthly expenses while you're floating in limbo land. For whatever weird reason, the leave year usually ends the first week in January. So for instance, for this year, leave year ends January 10th, 2026. So oftentimes the last year of employment, it goes from use or lose time to try and strategically save as much of your annual leave as possible. Because in theory, if you carried over the maximum amount, which 240 hours is the max for most people, and then you strategically saved every hour that you got paid in that last year of employment, you'd have your official retirement date be 12/31, but then you'd cash out with 448 hours of annual leave. And that payment would come, like if you were retiring 12/31 of 2025, your lump sum payment for 448 hours of annual leave would be taxable income in the 2026 tax year. One thing you don't want to do is get to, like, let's say late October, early November, where you've had most of your annual salary paid out to you, and then you're looking at another chunk of leave time, adding taxable income on top of that. Leave is an important piece of the pie, and like we said, oftentimes bridging that gap while you're floating in limbo land, trying to get your full final pension payment out from OPM. Important considerations for FERS. So verifying your service computation date for retirement versus your service computation date for leave is an important one. You also want to check your high three estimate. High three is the one thing that tends to change in the different estimates. So knowing if they ran the estimate based off of your current salary versus like a forward projection of what your high three is going to be in a year or 2 or 3 years, that's always something to keep an eye on too. And then oftentimes people want to look at different dates. So if you have the luxury of having HR run mid-year, end of the year retirements, it's always a helpful tool if you have that at your disposal. Moving on to the different keep in mind the milestones of age and years of service. This chart is for minimum retirement age. So MRA is an important one if you're looking to retire at age 56 or 57 with 30 years of service under your belt. For a long time, a lot of people fell into that 1953 to 1964 age band where your age 56 was your minimum retirement age. But now, if your birthday was 1970 or later, 57 is the magic age for minimum retirement age, which ties directly into the 3 main key milestones for an unreduced FERS pension annuity. Assuming you want to retire with an unreduced FERS pension, MRA in 30, age 60 with 20, and age 62 with at least 5 years. If you hit any one of those 3 milestones of age and years of service, your calculation factor is going to be 1% times high 3 times years of service. For a full unreduced FERS pension, you got to retire at age 62 with 20 or more years of service, and then that pension calculation goes up by 10%, which would be 1.1 times high 3 times years of service. Sometimes it's a conversation of, do I want to retire at 60 or hang on to 62 to get the extra 10% on the pension calculation bump? That one usually hinges on how close to burnout status people are with current work situations. So more often than not, a lot of people tend to go at 60 versus 62, but kind of a personal preference thing there and what makes the most sense for your individual situation. Moving on to question number 2. How do you plan to use sick leave and annual leave before retirement? We kind of touched on annual leave a little bit, but this one's just another refresher. Again, end of December is usually the most popular date for folks. This year's kind of unique because some of the folks that took the fork in the road offer, their retirement date's going to be the end of September, but that's a byproduct of the offer that was on the table. Again, you can maximize that carryover from the previous year, or 240 hours is the base carryover for most folks. And then, like we said earlier, Last year of employment's kind of not so much use or lose, it's strategically trying to save as much as possible. But sick time in retirement, it's important to remember that you also get credit for your sick time. So all retiring CSRS and FERS employees get credit for their unused sick leave hours. Sick time adds additional months and days and months onto your first pension calculation. Kind of a base measuring stick that you want to go with. 2,087 hours of sick leave equals 1 year. And you can't use, so like, let's say you're trying to retire at 60 with 19 years of service. You can't use 2,087 hours to get you to that 20 years. They don't let you use sick time in place of service time. It just adds extra time onto the total pension calculation. So you'd have to hit that milestone of like 60 with 20 years. And then if you cashed out with 2,087 hours, it added an extra year onto that pension factor that they were using. And then this one's just a snapshot of a sick time chart. So you just kind of go across the list to the number of hours that you have at the point of retirement, and that tells you how many extra months and days you add on to that pension calculation. It's a nice feature that they started crediting time for sick leave, because years ago they used to call it the first flu, where people would have thousands of hours of sick time accumulated, and if they didn't get any credit for it, they'd just be gone for long periods of time. So Uncle Sam caught onto that realization and started crediting half time or half credit for sick time. And then I think it was 2014 is when they started giving you 100% credit for sick time. And again, just keep in the back, you can't use sick time to get an extra year of service. It just adds on to your pension. So moving on to question number 3, have you requested an official retirement estimate from HR? Sometimes these aren't the easiest thing to get your hands on, especially if you don't have an HR contact that's easily accessible. But it's important to know too that every year, usually in January, they update your FERS benefit statement. The FERS benefit statement has a lot of the same identifying information that you would find on a formal retirement estimate from HR. So this is just a snapshot of the first page of just a base FERS benefit statement. You always want to confirm service computation date for retirement versus service computation date for leave. You don't want any surprise. You want to confirm your service, your FERS retirement eligibility prior to the formal meeting about retirement. And it'll also give you a pretty good idea of pension estimate amounts too. We've seen a few interesting situations over the years. Just the discrepancy between a leave computation date and a retirement computation date. We were talking to an employee one time that had just gotten out of her meeting with HR, and she was under the assumption that she was retiring with 30 years of service. But the caveat with her situation was the first year of employment, she was getting paid as an hourly employee. So on her pay stub, her service computation date for leave had 30 years of service listed, but because she was paid hourly in that first year, her service computation date for retirement only had 29 years of service. So it was a situation where she could have retired, but just that 1 year difference would have meant that she would have taken a noticeable reduction on her first pension forever. She wouldn't have been able to get paid the first supplement. So it was just having that little brain fart of the minor difference between the one year and leave computation versus retirement computation can make a big impact on your total retirement time frame going forward. So those are details you want to definitely get ironed out before you're having a powwow with HR, thinking that this is your last day type of a situation. So this is just a snapshot. So inside of the first benefit statement, this is where you track down service computation date for retirement, which is what they're basing your pension off of. If you move on to section G, it'll give you an idea of what they have listed for your retirement eligibility. And then your section H will give you a rough idea of a pension estimate amount. So if you have a hard time getting a hold of an HR person that can easily run estimates for you, just flipping through the first annual benefit statement can provide a lot of important identifying information to get a jump start on the planning process. If you do have the luxury of getting formal estimates from HR, a nice one, GRB platform is a tool that you can run on your own, and it's usually part of your personnel file, and it's just a nice online tool that lets you run retirement estimates in real time on your end without necessarily having to rely on HR running them for you, especially in periods of time like now where you've got a lot of people that are scrambling to get information all at one time because of the fork in the road and the retirement buyouts that are floating around. So right now, it might be a little bit more difficult to get in touch with an HR person than years past. So always keep that in consideration for what's going on right now. And then this is just a snapshot of a formal estimate from HR or a FRB report. FRB reports are nice if you have the luxury of getting your hands on them. Not every agency has access to the FRB reports, but three most important pieces that you want to keep an eye on are gross pension amount, which would be that green highlighted number, surviving spouse benefits, and surviving spouse costs. So oftentimes they'll run these estimates with the auto default being the maximum survivor benefit. Maximum in Uncle Sam's language is 50% of your gross pension, but you want to know what that benefit's going to pay your surviving spouse, and you also want to know what's going to cost you. So knowing the right section to look at, or in this scenario, the benefit that would be payable to a surviving spouse would be the blue box that's highlighted there, that 1900 number, and the premium that you pay while you're an active retiree is that survivor premium, or $384 a month. So just knowing the key pieces of information to keep an eye out for on these estimates are helpful too. And then again, like we said a second ago, if you can get your hands on an FRB report, it's nice because it gives a detailed breakdown of your total service history. So if there's any gaps or any chunks of time that you paid a deposit for, these ones are nice because they'll detail that pretty clearly. Moving on to question number 4. Have you planned for survivor benefits for your spouse? So this is always an important one. Former spouse, order of eligibility on a surviving spouse benefit on the first pension. Former spouse with a court order, current spouse, insurable interest, and minor children. Lately, we've had a few conversations with folks that have former spouses in the mix. And it always takes a little bit of extra calculation because oftentimes there's a divorce decree or a quadro that takes place at the point of the divorce, but inevitably, oftentimes, let's say you were married to your former spouse for a 30-year career, and then you weren't married to that spouse for the remaining 2/3 of your career. You got to dig into the weeds to figure out. There's a calculation that takes place because your former spouse is only entitled to percentage that they earned up to that point, not necessarily your entire pension amount. So there's a pro rata calculation that takes place in those scenarios, which if you're in that boat, it might be worthwhile to reach out because that one can be a little confusing if you haven't seen that situation before. But this one's just a refresher on base surviving spouse benefits on the first pension. So it's always important to remember that in Uncle Sam's language, the maximum survivor benefit that you can leave for a surviving spouse is 50% of your first pension. But in order to leave that 50% benefit for a surviving spouse, you have to pay 10% out of your pension while you're alive and well as a retiree. So 10% to leave half of your pension to a surviving spouse, which is the maximum. The other option is the partial survivor benefit, or a quarter of your pension. You pay 5% out of your first pension to leave a quarter as a surviving spouse benefit. But one of the most important variables here is the box at the bottom of this slide. To leave the federal employee health benefit for a spouse, you got to go with either the maximum or the partial, 50 or 25%. FEHB it's an important piece of the pie because Uncle Sam pays about 70% of the cost of that health coverage through both of your lives. So you kind of keep in the back of your mind that FEHB and the surviving spouse benefit on the first pension are directly tied to each other. Moving on to question number 5. Are you up to speed on your FEGLI coverage? And do you have the right amount going into retirement? It's always important to double check what you have, especially if you haven't taken a look at FEGLI in a while, because it's easy to forget about it. If you had all 4 options of FEGLI, basic, option A, option B, and option C, oftentimes those are all separate deductions on your pay stub. So part of the reason it's confusing is you oftentimes have to add up the deduction for all 4 of them, multiply that by 26 pay periods and divide it by 12 to figure out what you're actually paying on a monthly basis for FEGLI. FEGLI isn't all bad. Oftentimes people hang on to basic and option A if they have FEGLI going into retirement and take what's called a 75% reduction, which is the most cost-effective way to hang on to some FEGLI coverage. Where FEGLI gets cost prohibitive is if, let's say, you had 3 multiples of salary or 4 multiples of salary or 5 times your salary, and you're 50, 55 in that age band. 50 to 55 is where people start to see the first round of premium start to double in FEGLI coverage. And really, it's the multiples of salary that are causing the premiums for FEGLI to snowball. So it's usually a question of you're probably going to drop those as a retiree anyways, because it's going to be cost prohibitive to hang on to them. So do you want to hang on to that coverage now, or let's say you're going to retire in 8 months? Sometimes people will reduce that if they don't necessarily need it in the near term. They'll reduce the coverage that they're paying for option B and take that money and put it into the money that they were paying on FEGLI premiums and put it into TSP. And then option C is up to 12,500 on it's family coverage, so up to 12.5 on each child and up to 25,000 on the spouse. Option C isn't very expensive while you're working. It's just it becomes noticeably expensive if you want to hang on to it as a retiree. So that's one where oftentimes people will hang on to it going into retirement, but definitely they'll drop it as a retiree because the premium becomes noticeably expensive. So thing to remember about basic too is, let's say you're 50 and you drop all your FEGLI coverage and get a $500,000 20-year term policy. If you don't get the right type of term, oftentimes that can put you in a spot where that $500,000 of coverage is going to expire in 20 years when you're 70. Whereas if you hung on to basic and took a 75% reduction as a retiree, you'd pay premiums from the point of retirement until 65. And then at 65, your premiums stop, and your basic amount of coverage goes down a little bit each month until you level off at a quarter of what you started with. But that quarter of what you started with stays in force forever. And then you have a window of time where that face amount's going down each month. So hanging on to FEGLI basic or option A with a 75% reduction is a way to hang on to some permanent FEGLI coverage. But usually people are getting to the spot where the house is paid off and they're whittling away these things that they were hanging on to life insurance coverage for the closer and closer they get to retirement. So it's not uncommon for people to not have quite as much life insurance in force as retirees as they did earlier on in their careers. Moving on to question 6. What's your withdrawal strategy with TSP savings? Or again, you've been saving and saving and saving for all these years. It's important to start thinking about how you're going to use this money effectively. And it's important to keep in mind that TSP is a complement to your first pension and the first supplement or Social Security. You decide how to use and invest it. You want to stay up to date on fund options throughout the long haul of retirement too. And you always want to try as much as possible to implement a plan for income and liquidity. You definitely don't want to set it and forget it as a retiree, or have a realistic conversation with yourself. Am I going to be devoting enough time to managing TSP as a retiree that I would need to have this chunk of money be managed and as effectively as I would want it to be, or generating an equivalent amount of return and income that I want relative to the amount of time that I have to spend on managing this chunk. So income potential is always important. Depends on how much you contribute and how much you save throughout the duration of your career. So maximizing contributions can significantly increase the more you put in, the more income it's going to generate at the point of turning on income from that, or at the point of retirement. It's not uncommon for TSP savings to generate just as much monthly income as a first pension, but you always want to understand the risk and reward difference between the main TSP funds, or just knowing the difference between how does G fund work versus C fund, or G fund's short-term treasury securities versus C fund, which is an S&P 500 index. One of them is like short-term safety, and the other one has quite a bit more variability in the marketplace, but also more potential to generate long-term gains. So this one's just a brief refresher on the individual funds. G fund and F fund are considered the two traditionally safer funds. G is short-term U.S. Treasury securities. F is fixed income. It's bond fund. C is S&P 500 stock index. I is an international stock index, and S is specifically a small cap index, or companies that aren't included in the S&P 500. The S&P 500's got 100 mega-sized companies and then 400 medium-sized companies. So small caps aren't specifically included in that index. That's why they have the S fund as a separate one. And then the life cycle funds now range all the way from 2070 down to L2025, or L income being the most conservative investment allocation on those. L2070 would be the riskiest, and L2025 or L income would be the safest of those. Or just knowing the structure of how the different life cycle funds work, or how the money's invested inside of a life cycle fund. Because you got to remember, all of the L funds are just a pie chart of GF, CS, and I that gets adjusted on a quarterly basis. So if you've got money in, like, let's say, sometimes people will have money in like L2030, L2040, or L2045, and kind of brain fart on the fact that they're getting a lot of overlap, and kind of the strategies are overlapping there too. This would be a snapshot of just the distribution of L2025 earlier this year. It's important to note that because it's L2025, there's 65% of the money is in the safest fund, G fund. Whereas the distribution for L2065 in January of this year has 50% of the money in stock funds or the S&P 500. So knowing how the different life cycle funds is important in terms of maximizing the growth potential and income potential of TSP savings going forward. And you also want to be pretty familiar on your distribution options. 4 main ones: lump sum payment, or that'd be like a lump sum directly paid to you, put in your checking account; full or partial rollover to a traditional or Roth IRA; TSP payments are a specific dollar amount; and a fixed annuity. Most of the time, most people are doing either specific dollar amount of monthly payments, or rolling the full or partial rollover to an outside IRA or Roth IRA. And if they have like a chunk of debt, or they want to buy a car, or something looming at the point of retirement that's kind of like a one lump sum expenditure, then depending on the amount, sometimes people will take a lump sum to pay something off. And sometimes it's a situation where they're pinpointing an amount that they want to leave in TSP for a specific reason. It's usually tied to when they retire. If you have the luxury of retiring prior to 59 and a half from the government, but you still have to plan around this age 59 and a half, that applies to pretty much every retirement savings account that's out there. You got to be strategic about what you're doing. So sometimes people will leave a specific amount in TSP and then roll the money outside the outside IRAs that are all earmarked to do different things at different times. Part of the reason why people leave a specific amount of money in TSP for a finite window of time is monthly distributions from TSP are an avenue for you to get monthly income directly from Thrift without having to worry about a 10% early withdrawal penalty. So if you fall into that category where you are retiring after the age of 55, or if you're a public safety employee like an air traffic controller, border patrol, law enforcement, you can retire at 50 and start using TSP distributions for monthly income and not worry about an early withdrawal penalty. So sometimes people are facing like a 56 or 57 mandatory retirement. They'll leave enough money in TSP and use it for monthly income directly from TSP to get them from 56 or 57 to 60. And then they'll roll the rest of the money out and invest that in outside IRAs. They're all earmarked to start paying income after they get past 59 and a half or 60 for round numbers. So, but this is just a kind of an overall snapshot of how that strategy works. The net effect is it's an exercise in pinpointing your short-term, midterm, and long-term income buckets. So this would be like a total snapshot of short, mid, and long-term. This would be a snapshot of just that short-term pool, or an example where somebody left enough money in TSP to generate $4,000 a month from age 56 to 60. And then at the point of retirement, they knew that they were going to be able to tap into IRA money at age 60. So in this scenario, they funded an outside IRA that was earmarked to pay income from 60 to 65. All the while, they had a long-term strategy going in place that was earmarked to pay them monthly income after 65, and then had an emergency opportunity bucket, which should be like that green account right there. The big four there are house, car, medical, and vacation fund. Because we're always particular about having a liquid growth fund that you can tap into in the event that emergencies crop up, so you don't have to worry about reducing potentially the monthly income that you're spinning off of the other accounts. So emergency opportunity money, it's always an exercise in pinpointing what you want for income and what you want to be invested in growing, but you got easy access to it for fill in the blank. Moving on to Social Security. Oftentimes there are a decent amount of questions that crop up about when to turn on Social Security. We always try to emphasize to folks, you got to be alive to win with Social Security. And most of the time with the folks that we're working with, it works out better for them to turn Social Security on sooner as opposed to later. The reason The reason the payment amount gets higher the longer you defer it is, let's say if you were at age 70 and looking at turning on 3,000 a month, the reason the payment amount is larger at 70 is because Uncle Sam's already squirreled away this pot of cash they plan to pay you as a Social Security recipient. Payment amount's higher at 70 because you're getting a shorter duration of payments out of that pool of cash that they've set aside for you. Whereas if you turn it on at 62, the difference between 62 and 70 is 8 years of monthly payments. And if you aren't spending every dollar of it on monthly expenses, you can save whatever's left over and reinvest it. So that's an important one to keep in the back of your mind. Minimum or full retirement age is an important variable for folks too. So like that big bold number on the front of the statement, that's the benefit that's payable at full retirement age, which for most folks is age 65 to 67. But if you're getting Social Security between 62, let's say you turned it on to 62, you would have an earnings test that would be applicable until you got to your full retirement age of 67, for instance. So that's one that people plan around, or usually the main reason why they're deferring Social Security later is if there's a it makes a lot of sense for them to defer it. So let's say you could retire from the federal government and then get a job working as a contractor, making about as much as you were making while you're working full time. If that's the case, that's situations where people defer tapping into Social Security. But if that's not the case, then you got to remember Social Security it's a monthly payment that's payable while you're alive and well. So the one thing, God forbid, you don't want to pay in all the years that you're working, get 1 year of payments, and then pass away when you're 71. That would be a worst case scenario with Social Security. And then Uncle Sam wins because he paid in all those years, and then he got a limited benefit on the back end. So, but there's a lot of conversations that take place about maximizing Social Security. So if you have any questions, just feel free to reach out. Moving on to question number 8. Do you understand how taxes will impact your retirement income? Oftentimes, people's federal taxes usually stay the same on a percentage basis, but state taxes are different for each state. We usually start for federal withholding between 15 and 20%, 20% often to the high side, but depending on like around here, state taxes are different in Kansas for retirees versus state taxes in Missouri for retirees. So always something that you want to look into or be aware of going into retirement. And then there are different each state taxes benefits differently. So different taxation on Social Security benefits for supplemental payments, TSP money, IRAs, 401ks. Those are always the differences in state tax rules are very important, especially if you spend part of the year here, part of the year in Florida, for instance. You want to be aware of the differences between those. This one's just a refresher on federal tax brackets. It's important to remember they're progressive. So you don't just go to the band that you fall into and multiply it by that percentage. But standard deduction amount for 2025, this is just a refresher on those. And capital gains taxes, usually for most people, it's around 15%, unless you're making $533,000 or $600,000 for married, family, jointly. So 15% for capital gains. Capital gains is only applicable for an after-tax investment account or an after-tax investment. It's always frustrating that you paid taxes on the money you used to fund that investment, but then if you go make money, Uncle Sam says that's great, but you're going to have to pay us an extra clip in capital gains taxes. So if you have like an after-tax investment account and you've sold a holding for a gain that you've held for longer than a year, then you pay capital gains taxes as opposed to ordinary income taxes. And then this one's just a refresher on state taxes in 2025 in Missouri. So one of the big updates for Missouri last year is that public pensions or FERS pensions are tax exempt now, and Social Security and retirement Social Security benefits are also tax exempt. And the overall tax rate was reduced to 4.8%, whereas Kansas is still a little bit higher. Kansas for a while has had no state income tax on federal pensions. The new update for 2025 in Kansas is there's no state income tax on Social Security recipients. And for Kansas, there's also no state income tax on TSP distributions, which isn't one that a lot of accountants know. So if you want the specific IRS or the specific code section, we can get that over to you. But Kansas's tax rate for most people is 5.7%. I'm moving on to FEHB. Are you clear on your federal health insurance options in retirement? You must have been insured at the point of retirement. You must have been enrolled or covered 5 years preceding retirement. And the government treats CSRS and FERS surviving spouses active employees. The big one there is that Uncle Sam subsidizes the FEHB premium through both of your lives, and they pay a little over 70% of that cost through both of those lives. This one's just a refresher on when open season rolls around. Sometimes it's nice to know that you can shop different health plans by your zip code. Inside of OPM's website, if you go to the insurance tab, healthcare plan information, and compare plans, you can shop up to 6 different plans by your zip code, which is, again, if you spend part of the time here and then go to Florida, for instance, the plans that are the most competitive in Florida aren't necessarily the most competitive plans here, and they're always constantly changing and evolving. So just periodically logging in and seeing where you're at is an important one. And what should you know about the FERS supplement? So the FERS supplement, it's kind of like Social Security bridge payment. It's designed to bridge the gap between your FERS retirement and age 62. So if you're in that boat where you were retiring at MRA with 30 or 60 with 20, or you had to retire mandatorily at 56 or 57, these would be folks that would take advantage of that FERS supplement. And the more years of FERS service you have, the closer that supplemental payment is going to be to what your age 62 Social Security payment is going to be. So the more FERS service you have under your belt, the closer FERS supplement is going to be to whatever your payment amount is listed for age 62 Social Security. They're kind of like directly tied to each other. The FERS supplement's never as much as age 62 Social Security, but the FERS supplement is calculated based off of what your age 62 Social Security payment is going to be. And it's important to remember too that while you're getting that supplemental payment, you can't go out and make an unlimited amount of money. But in terms of like W-2 salary type of income for 2025 numbers, you can make $23,400 annually or $1,950 a month and not worry about Uncle Sam reducing that supplemental payment. Moving forward, so how do you start the planning process? For us, it's usually at least 2 or 3 steps. First meeting, we always call it a fact-finding meeting. We send you a list of identifying information to gather, and the more accurate that information is, the more accurate we can be with the information that we're presenting to you. Second meeting, we take all that info and put it together into a written plan where we just break down different options that you have for what do you want to do for your pension, what do you want to do with the FEGLI covers that you have, what's the supplemental payment amount going to pay, what's your net income going to look like, and usually the most important one, people are looking for a net monthly income comparison and an income strategy and investment strategy with what's due with TSP savings. So spend a lot of time working with folks on that. And we also run a net monthly income comparison, which is important because it breaks down what you pay for while you're working full time versus deductions that go away as a retiree. So. And then in subsequent meetings, it's oftentimes a refining process of finalizing which options you want to go with for the federal pieces, weighing the pros and cons, what's due with the TSP income strategy, and answering any questions you have, finalizing the strategy with generating income, starting the process of funding new accounts, and managing those assets going forward. The relationship with us doesn't stop at the point of retirement. So oftentimes it starts at the point of retirement and then it's ongoing from there. And usually plans need to get adjusted as life happens. So that one's just a matter of figuring out a time to sit down and make adjustments to the plan based off of what's going on in your life. What are the important items to bring? Like we talked about earlier, if you can get just a recent copy of a pay stub or a leave and earnings statement, that one's very important. Any sort of retirement estimates that you can get your hands on. A recent TSP statement always helps. Just get an idea of approximate balance and the funds that you're using. Any other investment statements that qualify as retirement income, detail on any outside life insurance or long-term care policies outside of FEGLI. If you got term policies, you want to know how far into the term they are, whether or not they're whole life, universal life. Social Security statement, if you can get your hands on one. Divorce decree is important, and spouse's benefits if you want to add that into the mix. Our goal is to provide every federal employee we talk to with a customized analysis of their benefits and retirement options. How about any questions?
There aren't any questions. David, do you have anything else?
Thanks for tuning in, everybody. If you think of something that didn't come up on the call and you want to reach out, feel free to give me a call. You can always send me an email or submit your question on our website. Thanks for tuning in, and I hope to talk to you in the near future.